Hello, everyone, and welcome to this Energy Quick Chat with Abhi Rajendran. He's the head of global oil and downstream markets at Energy Intelligence. Welcome to this interview chat, Abhi.
Thanks for having me.
Now, Abhi, way of introduction, big oil companies are back in the news with the release of their latest earnings. The results from Saudi Aramco, Chevron, BP, and Exxonmobil, among others, come against a backdrop of headwinds in oil production, supply, demand, pricing, and even geopolitics. Now, let's chat with you, Abhi, on those quarterly figures and the facts behind those numbers. Give us your thoughts on the overall financial performance of the big oil firms.
The earnings results from this past quarter from big oil, big energy, including the national oil company Saudi Aramco, they were pretty mixed. I would say, I think the upstream results were by and large as expected. Especially on the oil side, there was certainly some weakness on the natural gas side because of weaker natural gas prices. But I think certainly that we saw a downward shift, and especially on the downstream parts of the business, compared to the last couple of years. Now, of course, 2 years ago when Russia, Ukraine, that crisis first began, we had a huge jump in refined product prices, even petrochemical prices. Along with every energy price, and especially downstream refined product prices were elevated for a couple of years, and they've started to come down. They started to come down in part because of some demand questions, but also supply ramping up, in terms of refinery capacity. And so the downstream parts of the business, I think, were the areas where big oil results were quite soft. So I think, look, generally speaking. We've seen oil prices on a little bit of a downward trajectory over the last couple of years, but it's been a bigger drop for refined product prices, for margins, and for cracks, and that's something that big oil definitely felt. But they still put up pretty strong cash flow numbers, pretty strong earnings results relative to history, relative to kind of going back to before the Russia-Ukraine crisis. But still, just kind of normalizing a little bit from some excess profits over the last couple of years.
Yeah. So how did these oil majors navigate the pressure on refining margins and production costs?
All these companies were sort of expecting some of these supersized profits and margins to normalize at some point over the next couple of years. Some of the initiatives they've been taking are on the cost side, on the efficiency side, optimizing both of those, optimizing CapEx as well. So they've been, pretty prudent and pretty efficient on the cost side. That's definitely helped them, to kind of navigate, this downdraft in the downstream results. So again, I think if I just kind of look across the set of big energy companies, the results were still pretty solid, but it was definitely much more driven by the upstream than the downstream. But again, the companies generated solid cash. Some of the companies that still have like a slightly higher, more elevated level of debt, they were able to reduce their debt, or at least their net debt. So net, I think the results were still quite solid, just that the expectations had to be lowered after what we saw for the last couple of years.
So where do you think the main pain points are for these big names in the industry?
Yeah, I think the main pressures now are over the next couple of years to think about the fact that on the demand side, especially for oil, that growth may be slowing down, right? That the global oil market may be starting to feel the pressures of electrification, of decarbonization, energy transition, especially for gasoline demand and in Europe for diesel demand as well, for cars. And so I think that's something that the big oil, big energy business model will have to keep an eye out for and adapt to, which is to see what that slowdown of demand growth looks like. I think even this year, demand growth is going to be weaker than many expected a couple of months ago. It's still going to be solid demand growth, but certainly not some of the more robust forecasts that were projected a few months ago. So that's something that they're going to have to look at over the next couple of years. And then on the supply side too, the supply side, look, the oil market is has a lot of supply and a lot of capacity available. OPEC Plus is sitting on 5 to 6 million barrels a day of spare capacity. There is still growth coming from the Americas, both North America, driven by shale, of which many of the big oil companies are pushing that growth, but also Latin America with Brazil and Guyana in particular. And so there's supply growth still coming. And so I think we've seen this downdraft and downstream results. My expectation is that we'll probably see a continued slide in oil prices as well over the next couple of years. Not the 80s, 90s that the companies enjoyed over the last couple of years, but probably more the 70s as the market has to digest both slowing demand growth and also, a bunch of the supply still coming online. So I think that's kind of the next challenge. And again, for big oil, big energy companies, it's going to be all about managing costs, delivering efficiencies, optimizing their wellhead, and lowering production costs wherever they can. And then also being careful about CapEx and making sure that it aligns with, maybe a slightly lower cash flow outlook going forward, but also the fact that they still have to return a lot of cash to shareholders in the form of dividends and buybacks. So those are, I think, the key challenges for big oil to think about the next couple of years.
Now, I'm glad you mentioned dividend payments. Now, Saudi Aramco holds its huge $31.1 billion dividend payments in the second quarter, despite delivering lower profits. Is this sustainable over the rest of 2024 and beyond?
Yeah, I think short term it is. But again, I think the next couple of years, it's going to be a challenge to maintain this dividend because my expectation, you're going to have slightly lower oil prices. Of course, OPEC Plus and Saudi Arabia and Saudi Aramco will try to counter this with higher production as well. But that also is going to sort of put a little bit of downward pressure on prices. So again, net, their cash flow outlook is probably going to look a little bit better, but not that much better. Now they've had to use capital markets, the bond market, a share sale to kind of help plug some of the cash flow gaps. That's going to be something to watch for sure in 2025, 2026. I think over the short term, they'll be able to preserve the dividend. But, over the next couple of years, it's going to be something to watch, especially if you have this dynamic of a slowdown in oil demand growth globally, right? That also kind of makes pure oil companies less attractive as business models. That's something that Aramco will have to adjust to.
Now, how much of increased geopolitics will help to lift or dampen the performance of these oil and gas giants?
Yeah, look, geopolitics have been, a hot spot in different parts of the world over the last couple of years. I think with regard to the oil market and even the downstream markets, I think what we've found, what the market has realized is that, geopolitics, flares up and risks flare up in different parts of the world at different times. But eventually the market kind of figures it out, right? The oil market has been pretty efficient at minimizing supply disruptions and issues and, figuring out ways to reroute and get supply where it needs to get to. And then similarly, we've seen the same thing on the downstream markets as well. Now, gas, LNG, that's a little bit of a different story. But I think generally speaking, right now, of course, the biggest geopolitical hotspots are in the Middle East, with a range of issues and some threats to the kind of the Israel-Hamas problem, kind of extending to include Hezbollah, Iran, and other factors. And so, I think, again, the risk is always there. And I would say, potentially is as high as it's ever been. But the market has pretty much looked through all of this risk, is not really pricing in any of this risk. So I don't think that, it necessarily poses a risk to the big energy model. Now, look, if you had a big supply disruption, right, I think that would help oil companies because, you would have an outage or a disruption here or there, an increase in prices, especially if it's on a sustained, prolonged basis. That's something that'll definitely help oil companies that are able to produce and continue to supply the market. So that's something to keep an eye out for. But again, our expectation is that, that supply and production disruptions are going to be likely limited. And even even kind of the key actors in the region, right? Even the key, potential geopolitical players that are tied to some of these risks, let's say like in Iran, they are incentivized to sort of not, have their oil trade, their oil flows, their exports be disrupted, right? Because these are all kind of important sources of revenue for these countries. So I think something that the energy company complex is going to have to continue to watch. But again, I think geopolitical risks, even if they're there in the sidelines, will probably have kind of a muted effect on markets over the short term.
Right. So as we close, Abhi, I know you already touched a bit on this, but what's your overall outlook for oil company earnings for the rest of 2024?
Yeah, I think the second half of 2024 should be kind of a continuation of what we saw in the second quarter, right? More muted downstream results and profit expectations, but upstream results should hold up, pretty steady, pretty well. And my expectation is that oil prices will still, be roughly around $80 for the second half of the year, give or take. Again, that's for Brent, maybe a little bit lower for WTI, but that's my expectation. So you should see kind of a continuation of the results that you saw recently from the energy companies. I think maybe looking beyond the rest of 2024 to next year, probably a slightly more muted results on the upstream side, because again, I expect oil prices to be a little bit lower, maybe more in the mid to high 70s instead of the mid to high 80s as we've recently seen. But I think the downstream side is probably likely normalized in terms of profit margins, in terms of crack. So that part of the business should likely stabilize. So, just kind of net, I think the companies in general, now that expectations have been lowered, especially on the downstream side, should be able to deliver results and should be able to, kind of continue to generate pretty good levels of cash flow and profits, and keep investors relatively happy, as long as they're able to keep, a handle on the cost side, both operating expenses and capital expenditures.
Right. It's about making investors happy at the end of the day. We thank you for your time today, Abhi Rajendran, Head of Global Oil and Downstream Markets at Energy Intelligence, for sharing your insights with us on these quick chats. Bye for now.